You are about to open a mortgage calculator. You type in the loan amount, punch in the interest rate, and you see a monthly payment that looks manageable. But that calculator is only showing you one number, and it is the least important one. What it is not showing you is the total interest you will hand to the bank over the full life of that loan, which, in today's rate environment, on a standard 30-year mortgage, can easily cost more than the home itself. In this video, I'm going to show you exactly what mortgage calculators hide, what today's rates actually mean for your total cost, and the one comparison that should change how you think about every mortgage decision going forward. Stay with me. This is about 10 minutes, and it could save you 6 figures. Let me start with where rates actually stand right now, because this is what most people are searching today, and it is the foundation of every mortgage decision you are about to make. Mortgage rates have been stubbornly high since the Federal Reserve began its aggressive rate hiking cycle, and here is what that means in real terms for you. The same $400,000 loan that cost you roughly $1,900 a month just a few years ago now costs closer to $2,700 a month. That is not a small difference. That is $9,600 a year, nearly $290,000 extra over the life of the loan, just from the rate increase alone. And yet banks are still approving buyers at these rates. Which raises a question: who does this actually benefit? Here is the core problem with mortgage calculators. Most of them show you one number, a monthly payment. That is it. And our brains are wired to treat that monthly number as the cost of the home. It is not. The monthly payment is just how you deliver the money to the bank. The real cost is the total amount you will pay principal plus every single dollar of interest by the time that loan is completely paid off. Let me give you the exact numbers, and I want you to really sit with these. Imagine you borrow $300,000 at a 7% interest rate. On a 30-year mortgage, your monthly payment is around $1,996. The total interest you pay over the full loan is around $418,000. Now stretch that same loan to a 40-year mortgage. Your monthly payment drops to around $1,860. $136 less per month sounds like a better deal, right? $175,000 more, handed directly to the bank, in exchange for saving $136 a month. That is what your mortgage calculator was hiding from you. And remember, on the 40-year loan, you are also paying for 10 extra years. If you bought the house at 30 years old, you will not fully own it until you are 70 years old. Think about that for a moment. But the numbers are only part of the problem. The bigger trap is what happens to your equity inside that loan. And this is what almost no one talks about when banks pitch longer mortgage terms. It is called amortization, and it determines when you actually start owning your home versus simply renting it from the bank. In the early years of any mortgage, the vast majority of your monthly payment goes toward interest, not toward reducing what you owe. Banks design it this way intentionally. It maximizes how much interest they collect before you begin building real equity. On a 30-year mortgage, after 5 full years of payments, you have paid down maybe 6 to 7% of the principal. On a 40-year mortgage, after 5 years, you have barely touched 3 to 4%. What does that mean for you in real life? If you need to sell your house in year 5, maybe a job loss, a health crisis, a relationship change, or simply needing to move for work, you have almost no equity to take with you. You have been making payments every single month for 5 years, but the bank still owns almost all of it. This is how home ownership stops being a wealth-building tool and becomes a rent to the bank arrangement. And here is the part that makes this even more frustrating. Banks and mortgage companies market the 40-year product as an affordability solution, as if extending the loan is doing you a favor. But let us think carefully about what affordability actually means. If a house costs more than you can genuinely afford, lowering the monthly payment by stretching the loan does not make the house affordable. It makes the debt sustainable. And those are very different things. Real affordability means you can buy the home and still save for retirement, and handle an emergency, and not be financially destroyed if your income drops for 6 months. A 40-year mortgage fails all 3 of those tests for most people. Meanwhile, wages have not kept up with housing prices. So the 40-year mortgage is not solving the gap between what people earn and what homes cost. It is masking that gap. It lets prices stay elevated because banks can always offer a longer loan term to make the numbers appear to fit. You are not getting a better deal. You are getting a longer leash. So, what are your actual options if a standard 30-year mortgage at today's rates feels genuinely out of reach? Because I am not going to just tell you the problem and leave you there. Here are 4 real approaches that thoughtful buyers are using right now. Option 1. Buy in a lower cost of living area. Remote work has made this more viable than any previous generation has ever experienced. If you can earn a city-level salary but purchase a home in a smaller or secondary market, your 30-year mortgage becomes very manageable. A $300,000 home at 7% interest is a completely different financial story compared to a $700,000 home at that same rate. You do not have to give up quality of life to do this. Many mid-sized cities across the country offer excellent schools, low crime, good infrastructure, and a genuine community at a fraction of the price of major metros. Option 2. Save a larger down payment before you buy. I know this feels slow. It can feel like the finish line keeps moving. But here is the math. Every extra percentage point you put down reduces your total loan amount, lowers your monthly payment, and once you hit 20% down, eliminates private mortgage insurance entirely. And private mortgage insurance can add between $200 and $400 to your monthly payment without building you a single dollar of equity. More importantly, starting with a larger equity position means you begin owning a meaningful share of the home from day one, not 3 to 4% after 5 years of payments. Option 3. Consider a 15-year mortgage. Yes, the monthly payments are higher. There is no getting around that. But here is what you gain. You build equity at roughly twice the speed. You pay dramatically less interest over the life of the loan. You own the home outright in 15 years instead of 30 or 40. And banks often offer slightly lower interest rates on 15-year terms because they carry less risk. If you can stretch to a 15-year mortgage payment, it is almost always the better wealth-building decision. Even if it feels tighter month to month, the long-term outcome is dramatically more in your favor. Option 4. Rent strategically while investing the difference. I know this one is controversial. Our culture tells us that renting is throwing money away. But in a market where home prices are this elevated relative to income, there is genuine math that supports renting a modest place while aggressively investing the money you would have put toward a down payment or the difference between a high mortgage payment and a lower rent payment. It is not always about owning the house. It is about building wealth. And sometimes those are 2 different paths. None of these 4 options are painless. None of them are easy. But every single one of them is better than locking yourself into 40 years of interest payments on an asset that may not appreciate enough to justify the total cost you will have paid. If you want to actually run these numbers for your own situation, see exactly how a 30-year versus a 40-year mortgage plays out for the specific home you are considering. I have been using a budgeting and financial planning tool called YNAB to model exactly this kind of planning. Decision. It stands for You Need a Budget. It lets you map out your income, your debts, and your monthly obligations so you can see clearly what you can genuinely afford, not just what the bank is willing to approve you for. Those are two very different numbers. It is free to start. The link is in the description below. Here is the bottom line. A mortgage calculator is a useful tool, but only if you know what it is not showing you. The monthly payment is just the surface. Underneath it is the total interest, the amortization schedule, the equity timeline, and the real question of whether this loan is helping you build wealth or simply keeping you in debt for 4 decades. Homeownership remains one of the most powerful wealth-building tools available, but only if you structure it in a way that actually serves your financial future, not just your monthly cash flow. And that starts today. Before you open the calculator, before you sign anything, before you fall in love with a listing. The people who build real wealth through homeownership are not the ones who got the lowest monthly payment. They are the ones who understood the full picture before they committed. And now, you do too. If this video gave you a clearer picture of how mortgages actually work, subscribe to this channel. Because every single week, we break down exactly these kinds of financial decisions in plain language, so you can make smarter choices with your money without needing a finance degree to understand it. And the next video is one you genuinely do not want to miss. We are covering what actually happens when you miss a mortgage payment. Most people assume it goes straight to foreclosure. It does not. And knowing the real timeline and the real options available to you could be the difference between losing your home and keeping it. That video goes live this Thursday. I will see you there.